The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello, welcome to Squawk Box. Here are your headlines today. Nvidia powers the Nasdaq to a fresh record high and its fifth straight positive week. But the Dow tails off, closing down over 2% for the week. Chinese industrial profits bounced back to growth in April, providing a boost to policymakers as they try to reignite the world's second largest economy.
G7 finance ministers hit out at China's trade policies while edging closer to a deal that would see a fresh loan to Ukraine using seized Russian assets. French President Emmanuel Macron kicks off a rare state visit to Germany, urging voters to reject the far right in European parliamentary elections.
At extremes, in particular the far right and nationalist movements, seem to seduce people. But often our compatriots forget that if these parties had been in charge, everything they value about Europe would not exist.
Good morning. I've got to say, a lot of AI fever in the markets again last week. Not necessarily just the big FANG stocks, though. You saw it stretch a little bit further across tech universe, and having been at a big tech event, I can tell you it's very much all systems go. The amount of investment that's still pivoting off the sidelines. You'd think it's already there, but a lot of the VCs haven't really committed as much money so far in terms of AI, so that's still ahead of us. And there's a big SoftBank story we're going to talk about this morning, which tells you about the commitment from Masayoshi-san. But I think it is suggesting that even though we think we've seen a ton of money hoarding into these big AI trades now, it's still not necessarily there right across the VC world.
Do you think, are we in the next phase of AI investment? Because you had that initial ground up phase, which is what a lot of entities sort of built up on perhaps of late. But now, kind of the next phase to say, we need to see specifics on AI, to see which industries are actually going to, because everybody had an AI plan of sorts and just threw AI into their commentary and their stock went up. Now, it seems like you have to really hit the road.
It was a bit picks and shovels, and those that are monetizing the Microsofts and Alphabets of these world, right? But I think now what you're seeing is the startup phase. A lot of companies have been created overnight that are working with these large language models. They're coming up with their own use cases. So it's like the past decade or so we've seen this app-based development. Every time we've had new technology, new industry to disrupt, you've seen that come very quickly through. And even when it comes to, say, ride-sharing systems, it reminds me that you don't know which particular one is going to be a winner, and this is where it gets very difficult for the industry. They've got a sector bet. You've got to place your bets across all the different players in a sector. If you like the sector, you can't pick one because you could be backing the wrong horse.
So it's
that
like
phase again.
Pray.
Yes, so we're back to that phase where if you see some sort of disruptive industry coming to market and it's AI-based, you have to put the chips on that sector and you have to keep watching these different startup plays. So it's very much like the past decade that we've been in, and it starts again, right?
I wonder if that makes SoftBank a winner in this case, because they've kind of taken it easy. I mean, it's a story we'll discuss, but kind of try to assess what works first and then gone into it. Same thing with Apple in some regard as well.
If you've got the firepower, then you might be well perched. But let's face it, things are a little bit different. You've seen credit costs escalate. You've seen a lot of people still invest in some businesses that haven't even been able to exit yet. I mean, we've seen that over the weekend too with hedge funds. They're not getting money back in because some of the entities haven't made exits, and then the money's not being reinvested in hedge funds. So the dynamics around the credit market that we've seen for the last number of years has some bearing on the ability to invest in this cycle.
Well, good stuff. Well done out of Viva Tech as well. That was really great. So lovely work out of Paris. But a lot happening this week as well. Let's get right into it. Why don't we? Markets across the United Kingdom as well as the United States are closed then today for a public holiday. But a quick recap of how things then ended out on Friday, particularly out of the United States. Then you actually saw some green across this board. It was only just though for the Dow Jones Industrial, managing to find some significant gains. In fact, so much so that we had the Nasdaq close at record territory, 1.1% higher then as well, and was the record 11th record close then for 2024 then for the Nasdaq Composite. In fact, none other than Nvidia, of course, pushing things up 2.6%. It actually beat out the worries about the interest rate cutting cycle out of the United States and when that might begin. And seemingly Nvidia more significant to some extent then than the Fed last week. 10 of the 11 sectors were actually in positive territory, led by communication services. That went up 1.3%. So the overall index, or the broader index, also going up 0.7%. Overall, week to date as well, you can see some gains, particularly for the Nasdaq, again, that tech counter, but flatlining the S&P 500. The Dow Jones actually dipping off 2.3%. Here's your bond market look then. We're still edging towards, or looking like 5% could be in play for the 2-year then. 4.948 is where we're sitting on that one. Of course, the 10-year note then still close to that 4.5 mark. In fact, there, the US Treasuries were little changed, and investors still weighing up recent economic data. Has fired hot and cold out of the United States, perhaps a few worries as well as to whether some of that data is beginning to cool off in certain parts. Onto your dollar crosses then here. It's a firm start to the week, particularly for parts of the dollar here. FX trade has been dominated of late then by the hunt for carry, particularly in recent months. Then this has punished low rate currencies and supported the dollar. So you're seeing the sterling, sterling at 127.42 there, pretty much flat this morning. 108.48 then for euro dollar. Now, dollar yen has been one that we have been watching, of course, of late. 156 is where we are now, easing off from that 157 we had seen even just towards the late part of last week. 155 to 157 seems to be the current range. Let's get on to the Asian market picture then as well. Today, Asian stocks up, industrial profits out of China. Of course, the story we'll look at then, rising the first 4 months of the year. More economic data to follow as well this week. Yes, out of China, even out of India. In fact, China's got PMI numbers out on Friday. India posting fiscal Q4 GDP numbers as well this week. China also has set up a new state-backed investment fund with $47.5 billion worth of capital in it, and that is to try and boost the country's semiconductor industry. Not another interesting story to kind of look out there. Speaking of China, the Shanghai Composite managing to move up 1/3%, 0.4% higher out of the Nikkei 225. Now, profits at China's industrial firms rose 4% to April, then reversing a 3.5% decline in the previous month. That comes as Beijing's stimulus measures start to kick in. Sam joining us for more on this one. Sam, beginning to kick in is certainly the right word here, and hopefully the Chinese authorities will want this to spur more for the country.
Very good morning to you, Arabile. Yeah, certainly an encouraging set of numbers that we got today. Certainly more encouraging than the foreign direct investment numbers that we got out over the weekend, but I'll get to that in a minute. But as far as profits at Chinese industrial firms, we did see more than 70 of these companies and these sectors actually seeing their profits improving, which is very much a good sign given that the slower than expected recovery over the last year or so has really been squeezing those margins. So what is this all telling us? Well, what it was consistent with certainly the other data that we'd been getting in April. So one, the industrial output, which surprised to the upside, marked an improvement there. And also when you look at the exports, given that we did see that jumping back into expansionary territory. So very much we continue to see this sort of lopsided recovery actually playing out for the Chinese economy, where things look fairly encouraging on the supply side, but not so much on the demand side when you look at the data points like the retail sales and the new home prices, which we got in April. And so this is one of the areas that many have been focusing on right now, is that China has been very much doubling down on manufacturing still, particularly in the high-tech areas, particularly for its growth, and more so pouring some of that credit and that investment into the manufacturing side more than the Chinese consumer. And herein lies the problem with some of the concerns around the overcapacity story as well, that it very much needs that domestic demand in order to absorb some of the capacity that it's pumping out at the moment. And in fact, although it was an encouraging headline number, you even had the Stats Bureau acknowledging that there is still weak demand. Not only that, but you've got this uncertain external environment as well. Now, as I said, the exports look pretty good for April, but right now it really is a story of volumes versus value at this stage. We know that Chinese exporters have been actually lowering those prices to keep some of those customers. Now there is this argument that we might see some front loading because of Biden's tariffs that have been announced that will be kicking in at the end of the summer. So that's something to watch as well. Not to mention you've got Janet Yellen, who's been in your neck of the woods over in Europe, talking about building this wall of opposition, trying to get G7 members on board with trying to keep the pressure on China over their concerns about China's unfair trading ways. So all of this, no doubt, in mind when they're talking about the challenging external environment. Not to mention, as I said, the other concerning trend seems to be the foreign direct investment, which still is falling down 28%, which just goes to show, that was the January to April numbers, that the campaign we're seeing at the moment just hasn't paid off in terms of attracting that foreign capital into the country. Back to you guys.
Sam, thank you very much for bringing us the update this morning. A chorus of ECB speakers are paving the way for the central bank's first rate cut next week. Speaking with the Financial Times, ECB chief economist Philip Lane said that barring any major surprises, the bank would be able to remove the top level of restriction. Those comments were echoed by other ECB board members over the weekend as they expressed confidence over the conditions to start easing monetary policy. G7 finance ministers issued a joint rebuke of China's trade policies following this weekend's summit in Stresa, Italy, accusing it of dumping cheap exports and undermining workers and industries. The group stopped just short of an agreement on using seized Russian assets to fund the rebuilding of Ukraine, with the European nations fearing they will be footing the bill if Kyiv is unable to pay it back. The issue is set to be at the centre of talks once again when the G7 leaders meet next month. Italy's Finance Minister Giancarlo Giorgetti said, while concerns remain over the finer details over the use of seized Russian assets, there is still a strong political will and unity among the G7 nations.
We have made some progress. It hasn't been finalized yet because there are several noticeable technical and legal issues. But what will be confirmed in the final declaration is a strong common political position from all the G7 countries.
Joining us now is Rebecca Christie, who is Senior Fellow at Bruegel. Thank you so much for joining us this morning, Rebecca. Let me just pick up on the Ukraine story, because this is something that has been discussed for a while now, just to use these frozen Russian assets and some of the interest that's been accrued on these assets to repay for the rebuilding of Ukraine. What are the obstacles here? Because still a lot of technical factors have been cited. There's reluctance still at some European levels to adopt this. But just walk us through some of the technicalities.
Sure. Good morning. Thanks for having me on. The financial engineering required to create a bond based on interest from cash sitting in accounts that are immobilized because of the Russian sanctions is fairly complicated and involves a set of guarantees and other arrangements to make it work. Let me just back up a little bit and explain that no one is talking right now about using the $200 billion or so in Russian cash that is sitting at Euroclear, which is in Belgium. Instead, this money, because it is no longer invested in securities, it's turned into cash, is earning interest. And that interest belongs to Euroclear, this company. It doesn't belong to Russia. So you're not seizing Russian money so much as making use of the interest. Fine. So what happened is European Union countries agreed that they would take this interest, keep it in a separate account, and start sending it to help Ukraine as soon as this summer. And this is something that the European Union has already done. A first payment of $2 or $3 billion is about to go in June or so. The question is, can they bring that forward? And one of the ideas that has been put forward by the Americans and others is to take these annual payments of $3 billion or so and advance them and try and give Ukraine $40 billion up front, perhaps by selling a bond, and then use the $3 billion in interest that rolls up every year to pay it back. The problems with this are interest rates aren't guaranteed. For example, the European Central Bank may soon cut rates, which will change the way that works. So you also have to decide who's going to buy the bond if you're going to pay fees to investment banks. And you have to decide who's going to guarantee it if something goes wrong. And that's where the rubber is really hitting the road. The Europeans and the Americans cannot agree on who should guarantee it and whose taxpayers might be responsible. And because of that, it's going to be very difficult to get a final deal, even though the political will is there.
Rebecca, there was a view expressed by the British, I think it was from the Foreign Secretary, David Cameron, talking about, look, there's going to be an amount owed by the Russians and reparations down the track, so we may as well just access this money that is sitting there and accruing an interest. But how much would it seemingly be an issue too? What would any final amount be? What would the end point be if we start tapping into some of this interest?
So legally, there is a big difference between tapping the principal, the immobilized assets themselves, and tapping the interest, which does not belong to Russia legally. Once you start using the principal either to guarantee or to pay back, even if you're not taking it right now, if you're saying, well, we figure that it will be included in any kind of peace settlement, so we may as well count for that. Once you do that, you're in a completely different legal terrain. So that's one of the challenges.
Rebecca, the other side of this, though, is that the World Bank President Ajay Banga has said that he's, absolutely open to the idea of managing what would be a G7 loan fund for Ukraine, backed by the earnings from those very same Russian frozen assets you've spoken about. How does that change things, if at all?
So the World Bank is a known issuer. If the World Bank sells the debt, that makes it easier to get to capital markets right away. The question is who guarantees the income stream? Because once you build the bond, you can't change the amount of interest that's needed to make the payments on the bond. So right now, the interest is earning about $3 billion a year. But if that changes because interest rates fall or because of other factors, then suddenly you have a gap. And the question is who pays for that? So does the G7 guarantee it? Do they guarantee it? One idea that I haven't heard, but that might be talked about, is using reserves at the IMF. Anytime you have taxpayer or money that belongs to a national treasury on the line, typically it has to go through parliaments. And most parliaments in the US Congress may be reluctant to put their money on the line, even in theory, to stand behind this bond.
Yeah, and I suppose it's all because of these technicalities then that big questions are being asked of the G7, saying, and this is Giancarlo Giorgetti, as we've just heard a moment ago, there's still strong political will and unity among the G7 nations. Do you still see that as being the case, despite the technical issues around even these frozen Russian assets and the like as well, and broader issues?
There's a lot of support for helping Ukraine and getting money to Ukraine. We heard the German finance minister, Christian Lindner, say it was time to come up with the next round of financing for Ukraine now that the EU and the US both have approved some plans. So the question is, should it be through this bond off the interest, or would it be more straightforward to do it another way? And that's where we may end up, depending on what happens with the leaders when they meet in a few weeks.
Rebecca, let me pick up on some of the trade tensions expressed at the G7, because this comes in the wash-up of some of the tariffs that have been unveiled by the Americans, and this is on semiconductors to batteries to EVs. And I spoke to Elon Musk last week about what's been lobbed on EVs. He's saying he didn't ask for it and they were doing just fine without some of these tariffs. But in terms of solidarity, are we expecting to see anything from the Europeans? Because it feels like every European minister that I've spoken to is not necessarily in favour of higher tariffs, that they feel like open trade is the way forward for Europe. Is that just naive in this type of environment? Should the Europeans be siding with the Americans on tariffs against Chinese product where there is overcapacity?
So the whole thing about tariffs is that it's something that each jurisdiction or country has to do for itself. So it's not a question of solidarity. We saw the solidarity in the G7 statement saying they're concerned about non-market investments from China and they're concerned about these subsidies and they want to find some way of responding. But that's not the same thing as agreeing on a common tariff level or something like that. In the US, where the Chinese don't sell electric vehicles very much, lifting the tariff to 100% isn't going to have a practical effect on the number of cars sold. Probably it's just going to be a signal to China that the US is watching this. In Europe, where you have a different economic relationship, there probably will be most people expect some kind of tariff increase in coming weeks when the European Commission finishes its investigation. But the level will depend on which companies are affected. It will be set company by company, and it will be based on what kind of trade they're doing with Europe, and also with a view towards what kind of retaliation might come from Beijing, because European car makers also make luxury cars that they sell into the Chinese market, and they're concerned about that.
Yeah. Rebecca, thank you so much. Some interesting commentary as well there, and we'll continue to follow this one. Rebecca Christie, Senior Fellow at Bruegel, joining us this morning. Now, coming up on the show, signs of goodwill in the APAC region, China's premier calling for a reset in relations with Japan and South Korea. Also, a rare French state visit to Germany gets underway as French President Emmanuel Macron warns against rising far-right sentiment in the lead-up to next month's EU elections. And the Nasdaq hits another fresh record high on Friday ahead of the holiday weekend. We'll dive into the market action and rate outlook. It's coming up at 8 a.m. CET.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Welcome back. Now, trade is top of the agenda at the first summit in 4 years between leaders from China, Japan, and South Korea. Today's summit follows separate bilateral talks between the leaders, where security was a key focus. Sherry Kang joins us now for more on what to expect then from this trilateral. Sherry, good morning.
Good morning. And of course, it looks like they wanted to ease into it because it's been a while and close to 4.5 years for the three-way summit to happen. So they wanted to focus on the relatively easier elements, perhaps trade and economy. And the three leaders held a joint presser as well. Chinese Premier Li Qiang, so China's number 2, flying into South Korea, talking about how this is a new beginning for the three-way relationship. Japanese Prime Minister Fumio Kishida saying that this is a chance to revitalize a free trade agreement talks between the three countries. President Yoon Suk-yeol of host country of South Korea saying that this should serve as a chance to normalize the three-way summit as well in order to see substantive progress going forward. He also added that the three countries also agreed to build a transparent and predictable trade environment. Certainly, business was a key angle in this three-way summit, which was followed by business leaders summit as well, where the three leaders actually joined in as well. So it certainly looks like for South Korea and Japan, this is more of a balancing act and not wanting to look too much too close to the Biden administration in the United States, and also not wanting to look like they're avoiding doing business with China. And at the same time, for China, it's really the chance to tell the world that it's open for business, and especially when it comes to foreign investments. In fact, that was Premier Li Qiang's message when he sat down yesterday separately with J.Y. Lee, chairman of Samsung Electronics, saying that China's mega market is always open to foreign-funded companies and investments. And also China following up, a Chinese state-run media following up with this announcement of an innovation center as well. In fact, Premier Lee and J.Y. Lee talked about how the two countries' businesses should work together, especially in areas such as advanced manufacturing, digital economy, artificial intelligence, as well as green transition. Of course, it would be difficult to navigate after this three-way summit for companies like Samsung Electronics, given how they are so committed to the Biden administration in the United States and making all these heavy investments in that country already. But we'll see how things go, because it certainly looks like they have a common ground to work with at the moment.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.